Let's switch to the home builders now. KB Home up nearly 11% to start this year, seeing a small boost ahead of its earnings today as well. Let's bring in Ken Zener at KeyBank Capital Markets. Ken, where are we? Ken, are we at the inflection? Sort of an inflection point for the builders we saw in the back half of last year. What's next?
Well, I think the expectations, which were, it caused the initial overselling in the group, if you want to think about it cyclically, and now the optimism. And our call is versus the market specifically. For today, we've seen orders down 50% for the build to order builders, which includes KB. We're forecasting roughly 35. I think it could be farther than that. If you think about operationally, the home builders, right, there's this shrinking pie that Diane talked about. The question is, who's going to get more of that shrinking pie? And I think we've seen the build to order builders like KB and Toll, they've actually been lagging the companies like Lennar and DHI that have seen order rates fall only 15%. A good thing for KB is their lower margin degradation so far as they work out a backlog.
So, Ken, there are a lot of people, we've talked a lot, especially early last year, about how low the valuations had gotten. Now people look at these and go, okay, the valuations are back, but they're still, historically attractive. What would you say, especially as we have to ponder what the Fed's going to do in the next couple of meetings here?
Well, valuation is obviously very subjective at times. So price to book, KB's 0.8, 0.9. We have Lennar at 1.3. There is a very direct correlation between the builder's book value and the returns on inventory. And that's, I think, very important, as a name like NVR would highlight. The reality is these companies do look different versus past cycles, with the best builders at negative leverage. Companies that have lower returns on inventory, they still have, call it 30%, 20% net leverage. But as long as the builders, in a note we recently wrote, we call it ABC, always be closing. That generates cash flow, and it helps them reset their assets for the next cycle.
Yeah, roll the clip. I guess final question, do they all rise and fall together still in this environment, Ken, or do you think there's going to be enough differentiation to even do stock picking?
They are highly correlated. However, it's very clear that higher return on inventory builders over time aggregate market share, as well as if you just look at the processes that are enabling builders, some to contract 15%, some 50%. The actual math behind falling 50% and regrowing is very difficult versus those that have only fallen 15%, not only with their customers, but also the trade, which is very important to their growth prospects.
So finally, as we review this cycle compared with, the housing bubble, there are a lot of key differences. That was leverage fueled. It was overbuilding. There wasn't real demand. A lot of differences with the dynamics that we're seeing this time around. But do you think that earnings could be at a similar risk now as to what they were back then?
For the builders, if you look at KB, we're roughly 950 for this year, maybe a little higher. We're roughly 650 next year. I think the bias is still to the downside because we don't know for the margin. The builders, we do not expect these large impairments. If we have impairments of 10 to 15%, that certainly seems plausible given prices. It's not in our forecast, but that would certainly be taken into account with the valuations today.
All right. Ken, thank you so much. We appreciate it.
Thank you.